Aluminum is one of the most widely used industrial metals in the world, forming the backbone of industries such as automotive manufacturing, construction, packaging, and aerospace. When the United States experienced a sudden disruption in aluminum supply, it immediately sent ripples across multiple sectors. This episode was not the result of a natural disaster or factory collapse, but rather a shift in trade dynamics, specifically Canada, stepping back from a key supply role. The result was an overnight price surge that caught markets off guard. This video explores how such a disruption unfolded, why Canada's role was so critical, and what this means for the U.S. economy. By examining supply chains, trade dependencies, and market psychology, we aim to understand how a single shift can expose structural vulnerabilities in even the largest economies. Segment 2. Why aluminum matters to the U.S. economy. Aluminum is not just another commodity, it is a strategic material. The U.S. uses aluminum in transportation, defense equipment, food packaging, energy infrastructure, and consumer electronics. Its lightweight and corrosion-resistant properties make it indispensable. Any instability in aluminum supply affects production timelines, manufacturing costs, and eventually consumer prices. Unlike some raw materials that can be substituted easily, aluminum has limited short-term alternatives. This dependency makes the supply chain particularly sensitive. When supply tightens, manufacturers often compete for limited inventory, pushing prices higher. Understanding aluminum's central role helps explain why even a temporary disruption can escalate into a broader economic issue. Segment 3. Canada's role in the North American aluminum supply. Canada has long been the largest supplier of primary aluminum to the United States. With abundant hydroelectric power, Canadian smelters produce aluminum more efficiently and sustainably than many global competitors. Over decades, a deeply integrated supply chain developed between the two countries. U.S. manufacturers relied on Canadian aluminum as a stable, nearby, and cost-effective source. This relationship reduced transportation risks and ensured predictable pricing. When Canada altered its participation in this supply flow, it wasn't merely a trade adjustment. It disrupted a long-standing economic partnership. The suddenness of this change amplified its impact, catching downstream industries unprepared. Segment 4. What triggered Canada's exit? Canada's decision to step back was influenced by a mix of economic, regulatory, and strategic considerations. Global demand pressures, pricing disputes, and policy adjustments played a role. Rather than a single dramatic move, it was the culmination of mounting tensions in trade frameworks and cost structures. When producers find domestic or alternative international markets more viable, supply naturally shifts. Canada's recalibration was not aimed at causing disruption, but its timing and scale had unintended consequences. Markets often react not just to decisions themselves, but to how quickly those decisions alter expected supply patterns. Markets respond to uncertainty with speed. As soon as reduced supply became evident, aluminum prices spiked. Traders anticipated shortages, manufacturers rushed to secure inventory, and speculative behavior intensified. This chain reaction is common in commodity markets where supply elasticity is low. Even the perception of scarcity can push prices upward. In this case, the rapid escalation reflected both real supply constraints and market psychology. Once prices began rising, momentum carried them further, reinforcing concerns across industrial sectors. Segment 6. How price surges travel through the economy. Higher aluminum prices don't remain confined to metal exchanges. They move downstream. Auto manufacturers face higher input costs, which can affect vehicle prices. Beverage companies pay more for cans. Construction firms see increased material expenses. Over time, these costs may be passed on to consumers. This phenomenon, known as cost-push inflation, illustrates how a single commodity shock can influence everyday goods. While the immediate spike may stabilize, the lagged effects can persist for months. Segment 7. U.S. domestic production limitations. One key issue exposed by this disruption is the limited capacity of domestic aluminum production. Over the years, many U.S. smelters closed due to high energy costs and global competition. Reopening or building new facilities is neither quick nor inexpensive. This structural limitation leaves the U.S. reliant on imports during supply shocks. While domestic output can increase marginally, it cannot rapidly replace a major supplier like Canada. This gap between demand and production capacity intensifies vulnerability during disruptions. Segment 8. Supply chain fragility in a globalized world. The aluminum episode highlights a broader issue: supply chain fragility. Modern economies rely on just-in-time delivery and cross-border sourcing. While efficient, this system lacks resilience. When a key node fails or shifts, the entire chain feels the strain. Aluminum is a textbook example of how globalization improves efficiency but increases exposure to shocks. Diversification sounds simple in theory, but in practice, replacing a trusted supplier takes time and coordination. Segment 9. The role of trade policies. Trade policies shape commodity flows. Tariffs, quotas, and regulatory standards influence where producers sell their output. Even minor policy adjustments can alter profit calculations for suppliers. In the aluminum market, such measures can redirect supply away from traditional partners. While policies aim to protect domestic industries, they sometimes create unintended supply pressures. Understanding these policy levers is crucial to interpreting why market disruptions occur. Financial markets amplify physical supply issues. When investors anticipate shortages, they often buy futures contracts, driving prices higher. This speculative activity does not create the shortage, but it magnifies price volatility. In the aluminum surge, investor sentiment played a significant role. Fear of prolonged disruption encouraged aggressive positioning, accelerating the price climb beyond what supply fundamentals alone might justify. Segment 11. Short-term versus long-term impact. In the short term, price spikes strain manufacturers and increase costs. In the long term, they can trigger strategic shifts. Companies may seek alternative suppliers, invest in recycling, or redesign products to reduce aluminum usage. Governments may reassess trade dependencies. While painful, such disruptions often act as catalysts for structural change. The key question is whether these adjustments occur quickly enough to prevent future shocks. Segment 12. The importance of aluminum recycling. One mitigating factor is recycling. Aluminum can be recycled indefinitely with minimal quality loss. Increasing recycling capacity can reduce reliance on primary imports. However, recycling infrastructure also has limits and cannot immediately compensate for large supply gaps. Still, investment in recycling is often cited as a long-term solution to supply volatility and sustainability concerns. Segment 13. Alternative global suppliers beyond Canada. Other countries produce aluminum, but shifting supply chains is complex. Logistics, quality standards, political stability, and environmental regulations all matter. New suppliers may come with higher transportation costs or inconsistent output. This makes rapid substitution difficult. The Canadian supply was uniquely positioned due to proximity and integration, making its absence particularly impactful. Segment 14. Impact on small and medium manufacturers. Large corporations often hedge commodity risks, but smaller manufacturers usually cannot. For them, sudden price increases can squeeze margins or force production slowdowns. This uneven impact highlights how commodity shocks disproportionately affect smaller players, potentially leading to consolidation within industries. Segment 15. Lessons for economic resilience. This disruption offers clear lessons. Economic resilience requires diversified sourcing, strategic reserves, and domestic capacity planning. Over-reliance on a single supplier, even a friendly one, creates exposure. Policymakers and businesses alike must balance efficiency with resilience. Segment 16. Government and industry responses. Following the price surge, discussions emerged around incentives for domestic production and supply diversification. Industry groups called for predictable trade frameworks, while policymakers examined long-term strategies. These responses aim to prevent future shocks rather than reverse immediate price movements. Though indirect, consumers eventually feel the effects. Higher product prices or delayed availability reflect upstream disruptions. While consumers may not notice aluminum itself, they notice its absence or increased cost in everyday items. Segment 18. Market stabilization efforts. Over time, markets tend to stabilize. As new supply routes emerge and panic subsides, prices often retreat from peaks. However, stabilization does not erase the underlying vulnerabilities revealed by the shock. Segment 19. A case study in trade interdependence. This episode serves as a case study in economic interdependence. Even close trading partners can diverge when incentives shift. Interdependence brings benefits, but also shared risks. Segment 20, Conclusion. What this means going forward. The aluminum supply disruption underscores how fragile modern supply chains can be. Canada's exit did not just trigger a price surge, it exposed structural dependencies within the U.S. economy. Moving forward, resilience, diversification, and strategic planning will be essential. The lesson is clear. Economic strength today depends not only on scale, but on adaptability and foresight. Segment 21, Historical Context of U.S.-Canada. Metal Trade. The aluminum trade between the United States and Canada did not emerge overnight. It developed gradually through decades of industrial cooperation and regional integration. Shared geography, stable diplomatic relations, and aligned industrial standards made this partnership efficient. Over time, U.S. manufacturers optimized their operations around predictable Canadian supply. This historical dependence created a sense of permanence that reduced urgency for diversification. When such long-standing arrangements shift, the shock is greater because systems are built on assumptions of continuity. Understanding this historical backdrop helps explain why the disruption felt sudden, even though underlying pressures had been building for years. Segment 22, Energy Costs and Aluminum Production. Aluminum production is extremely energy-intensive. Canada's advantage lies in its access to low-cost hydroelectric power, which keeps production economically viable. In contrast, higher energy costs in other regions limit output or raise prices. When energy markets fluctuate or policies change, aluminum supply reacts quickly. This energy-metal link means that aluminum markets are influenced not only by industrial demand, but also by power economics. The disruption highlights how energy security and metal supply are deeply interconnected. Aluminum supply chains rely on smooth transportation networks. Proximity between Canada and the U.S. minimized shipping risks and delays. When supply shifts to distant producers, logistics become more complex. Longer transit times, port congestion, and higher freight costs add layers of uncertainty. These logistical factors contribute to price volatility, even if raw production levels remain stable. The loss of a nearby supplier therefore magnifies disruption beyond simple volume reduction. Manufacturers plan production months in advance based on expected input availability. Sudden aluminum shortages force companies to revise schedules, delay launches, or renegotiate contracts. Such adjustments are costly and disruptive. Uncertainty also discourages investment, as firms hesitate to expand without stable material access. This planning challenge explains why supply disruptions have effects that last longer than the initial price spike. Many aluminum buyers rely on long-term contracts rather than spot purchases. When supply conditions change, these contracts may be renegotiated or strained. In some cases, prices adjust automatically through escalation clauses. In others, disputes arise over delivery commitments. Contract rigidity can either protect buyers or exacerbate shortages, depending on terms. This complexity adds another layer to market reactions during disruptions. Some industries maintain strategic inventories to buffer against supply shocks. However, stockpiling aluminum is costly and space-intensive. As efficiency became a priority, many firms reduced inventories. This lean approach saves money during stable periods, but increases exposure during disruptions. The recent price surge renewed discussions about whether strategic reserves should play a larger role in industrial planning. Environmental standards affect aluminum production decisions. Stricter regulations can limit output or increase costs, influencing where producers choose to sell. While sustainability goals are important, they also shape supply availability. Balancing environmental responsibility with industrial resilience remains a challenge. The disruption illustrates how regulatory environments indirectly influence global commodity flows. Beyond commercial uses, aluminum is important for defense and infrastructure. Supply instability raises concerns about long-term access to critical materials. While no immediate shortages occurred, the episode highlighted the strategic importance of reliable sourcing. Governments often view such disruptions as signals to reassess material security frameworks. Rising prices serve a purpose. They signal scarcity. Higher aluminum prices encourage producers to increase output where possible and attract new suppliers. Over time, these signals help rebalance the market. However, adjustment is gradual and short-term pain is unavoidable. Understanding price signals helps explain why markets eventually stabilize after shocks. Material scarcity can drive innovation. Manufacturers may explore lighter designs, alternative materials, or improved efficiency to reduce aluminum use. While innovation takes time, supply disruptions often accelerate research and development. In this way, short-term challenges can produce long-term technological benefits. The aluminum market is global. Demand from construction, transportation, and renewable energy projects worldwide affects availability. When global demand rises simultaneously, even small supply shifts have larger impacts. The US-Canada situation occurred within this broader global demand context, amplifying its effects. Aluminum prices are influenced by currency fluctuations. Changes in exchange rates can make exports more or less attractive to producers. Currency dynamics may have contributed indirectly to Canada's supply decisions. These financial factors often operate quietly but significantly shape trade flows. The disruption underscores the importance of risk management. Companies that diversified suppliers or hedged prices were better positioned. Those relying on a single source faced greater strain. Risk management is not about predicting events, but about preparing for uncertainty. Regions heavily dependent on aluminum-intensive industries felt stronger effects. Employment planning, local investment, and regional supply networks experienced stress. These localized impacts show how national-level disruptions translate into regional economic challenges. Public narratives often simplify complex supply issues. While headlines focus on sudden shortages, underlying causes are usually gradual. Balanced analysis helps avoid panic and supports informed decision-making. Understanding complexity is essential for realistic expectations. Industry groups play a key role during disruptions by sharing data, coordinating responses, and communicating concerns. Their input helps policymakers and firms navigate uncertainty. Collaboration can reduce fragmentation during supply shocks. Looking ahead, North American aluminum supply may become more diversified. Investments in domestic capacity, recycling, and alternative sourcing could reshape the market. While change will be gradual, the disruption has clearly influenced long-term planning. The core tension revealed is between efficiency and resilience. Lean systems are cost-effective but fragile. More resilient systems are stable but expensive. Finding the right balance will be a key challenge for industries dependent on critical materials like aluminum. Close trading partners benefit from policy coordination. Predictability reduces market shocks. This episode highlights the importance of communication and alignment to maintain stable supply relationships, even amid changing economic conditions. While this case focuses on aluminum, the lessons apply broadly. Modern economies depend on complex supply chains. Disruptions reveal hidden dependencies and prompt reassessment. The goal is not to eliminate risk, but to manage it intelligently. Aluminum's story is ultimately about preparedness, adaptability, and long-term thinking in an interconnected world.